Could Snowflake become the next mega cap stock that also has mega profits that we talk about regularly here on the channel? We'll talk about that and more on today's show. What is going on, investors? Hopefully you guys are doing well out there. Time to talk about Snowflake, ticker symbol SNOW. This company reported their Q3 earnings after the bell. This was yesterday. We'll get into them. We'll take a look at the numbers, some interesting things happening here from a revenue and a profit perspective, or lack of profits. We'll come over here and actually look at the gross margins, how this business is scaling up. I think that's really important when you're analyzing a company like this, is how are those expenses scaling up? And I think what you're going to see here is surprising. And then we'll come over here and look at this from a technical perspective. It's actually setting up kind of nicely. I think you can have a strong rally in this stock if this momentum and this technical chart pattern continues to hold with Snowflake. We'll talk about that and more on today's show. Let's kick things off with the stock down 54% over the last year, like a lot of stocks that we're looking at. This one's got a $49 billion market cap on this one. Now, we've got Q3 revenues that came out after the bell yesterday. Revenues at $557 million. So the thing that should just jump out right at you is you've got a company with a $50 billion market cap and just $560 million worth of quarterly revenue. So from a price to sales, price to earnings, price to cash flow, price to just about anything, this company's wildly overvalued. But what we know about the stock market and investors in general is they absolutely love strong revenue growth, and this is kind of the quintessential stock for this. I'm seeing out into calendar year 2025, this company is expected from analysts. Now, these expectations come with a lot of risk as well. Analysts are expecting at least 40 to 50% growth rate on this company's not yearly, quarterly revenues for the next 2 years, essentially. And so obviously, if this company is able to achieve about $1 billion quarterly run rate sometime in the calendar year 2025, you're looking at about a $4 billion run rate on that when it comes to yearly revenue. So you're looking at a slightly over 10 times sales when you're looking at sales 2 years into the future. So this company certainly can grow into this valuation from an earnings, a price to sales, all those types of things. But boy, we are still quite a ways away. Now, the risk obviously comes from Snowflake. If it starts to come underneath these expectations, well, the stock is absolutely going to continue to pull back. Now, we got a little bit of outlook for Q4. Revenue is expected to be between $535 up to maybe $540 million. The expectations were quite a bit higher, actually. I'm seeing expectations here for the company at $576 million. That would have represented about 50% growth. Looks like we're coming underneath that when it comes to those Q4. Now the company also gave us 2023 outlook as well, expecting revenues right about that 1.9, nearly $2 billion mark. Now, for the company in fiscal 2023, a shade over $2 billion was right where Wall Street had this one. So initially, this stock sold off because actually the Q4 guidance and the full year guidance for 2023 actually a little bit underneath expectations, but that's still over 66% revenue growth year over year. And then when you start to look out for subsequent years, again, Wall Street expecting over 40% growth for the foreseeable future. We'll see if Snowflake's able to deliver on that. Now, we had that revenue come in at that 560 mark, or roughly around that. Now, the other box that this company checks is they've got that high revenue growth rate. They've also got those massive sky-high gross margins off of $560 million worth of revenue, just $190 million in costs. That gave you gross profit of $366 million. This gives you a lot of money and a lot of things to play with when it comes to sales and marketing, R&D, and your general administrative expenses. We see over the last year, our total operating expenses rose by roughly $200 million from about $371 million up to closer to $572 million. So our operating loss expanded year over year from a loss last year on a quarterly basis at about $157 million. It is ballooned to over $206 million. Now, this company does have a boatload of cash on the balance sheet, and they're earning probably more and more as the days go by from an interest rate. They earned a whopping $22 million worth of interest income in just a quarter. And so while the operating business is not exactly profitable, they are raking in that interest rate on their cash balance. You see, for the 9 month, they raked in over $38 million when it comes to interest income. That will help out your net income, a little bit of your EPS, but again, it's still negative. When you pull down to net income, EPS, you are still negative. On top of that, that, you're getting more weighted average shares outstanding as they do very excessive and aggressive stock-based compensation over at this company. Nearly 10% dilution just in the last year. When you pull down to the balance sheet, like most companies that have recently gone IPO, not really a whole lot here other than a boatload of cash to the tune of nearly $4 billion in cash. That is going to earn you some interest income given where interest rates are, and you have almost no liabilities over at this company. So from a balance sheet perspective, exactly what you'd hope for with this company. Now, let's come over here and look at the cash flows, because as you know, with these wildly overvalued companies that are doing massive stock-based compensation, well, it impacts cash flows and usually impacts it in a very positive way. So we pull down a $201 million worth of net loss. Last year was closer to 155. We get to add back in $230 million worth of stock-based compensation. Last year, it was just $144 million. So yes, your revenue grew over at this company to the tune of, we'll call that about $220 million over the last year. This is revenue. Well, guess what? Your stock-based compensation actually almost exceeds just your revenue growth, let alone your net income losses and those types of things. These types of companies are just financing the growth of the company with stock-based compensation. And yes, in the shorter run, this is how you want to scale up a company. But in the longer run, if this company doesn't scale, well, this is terrible for anybody that has bought into shares more early on. So you take this 201 net income, you get to add back in dollar for dollar stock-based compensation like these people would work for free, and you come down here to net cash provided by your operating activities. It's actually not that bad. Nearly $80 million, up dramatically from about $15.5 million a year ago. You look at the 9-month basis, you're right at $330 million. We'll give them credit for another quarter where they'll do maybe another $80 million in positive cash flow. You're right at like $400 million worth of positive operating cash flow. Again, I'll remind you, we got a $50 billion valuation on this one. So you're still paying a massive premium for sales, massive premium for operating cash flows. But if you believe Wall Street and that these revenue growths can continue like this, well, this company won't comfortably grow into the valuation. It'll take some time, but you see out into calendar year 2028, 2027, you're at 4 or 5 times sales, which is not like egregiously overvalued when you're looking at a company that will likely also see its growth rate start to fall off a map at that time as well. The rest of what they're doing is about what you'd expect for a company in this position. The last thing that I want to show you is there are some positive metrics that if these continue to move in this direction, this is a very good sign for this company. You see on a quarterly basis, year over year, your GAAP gross margin on this company went from 70 up to 72%. So in this environment, to be able to raise your gross margins actually shows you that you probably have a pretty darn good product over here. Now, the other thing that I thought was actually pretty nice is take a look at your operating expenses. So again, we grew our revenue over 66% year over year, but take a look, our sales and marketing, again, this is on a GAAP basis, your sales and marketing as a percentage of revenue on a quarterly basis actually went down from 57% down to 51%. This means they're spending less on marketing to generate more and more sales. You see on a 9-month basis, it went down from 65% down to 54%. Pat yourself on the back, give a round of applause for management. They're doing a very, very nice job here. You see research and development, that ticked up a little bit from 35% up to 38%. I don't really mind with R&D, and our general administrative expenses, while they continue to rise, started to flatten out as a percentage of revenue from 19% down to 14%. This is exactly what you want to see with Snowflake. And again, the stock is overvalued, but if they can keep moving in this direction, there's not a ton of stocks that I would say that could grow into this valuation, but the blueprint and the recipe is here for Snowflake, so it's certainly possible. Whether or not it's probable they grow into this valuation, I am not 100% sure at this time. Now, in terms of a technical perspective, some interesting things going on. Now, in the kind of the micro trend, we are creating a very rapid series of lower highs on this one. Now, kind of the intermediate trend, we bottomed out on this one back in June, and it looks like to me we may have made a little bit of higher low back in kind of October, November timeframe. And so I see this one resolving actually one of two ways. Either we can confirm that this is a higher low here. If we confirm this is a new higher low over the previous low, this one has a pretty strong probability to rally likely up into the 180s, probably up into the previous highs, which are all the way up here to 203. That would be another $50 on top of this stock price. And it would run you right up into an area of resistance up here again, about 203, 205 on the stock. These types of stocks are ones that I would take profit on. If you take a risk on this, it doesn't mean you have to do your whole position. If you buy 10 shares or 100 shares, it doesn't mean you have to sell all of them or you have to take profit on all of them. But you got such a big valuation on this one, and if this growth rate just takes a little bit of a speed bump or a hiccup, well, this stock will likely reverse around this area and head much, much lower and essentially just kind of continue a trend that it's really been on since November of last year. For my personal taste, a little bit too much risk based on where we're at in these markets, where you got all these other stocks that are down 50, 60%, and a lot of them have much larger buybacks, or actually a buyback and a dividend, and actually churn out operating profits and operating cash flows that far exceed typical valuations. But this one certainly can stay on the watch list, and if you do like risk, this is one that I could see somebody dabble with. I just would take profits from a technical perspective, as it's actually more likely that Snowflake doesn't meet these aggressive price targets and retail investors start to flame out on this one, and it continues to trend down to a valuation that certainly makes more sense. Once it reaches that valuation, certainly could be a stock that we add to our portfolios at that time. Hopefully, you guys enjoyed today's video. We'll be back in soon with more. Good luck with your investments.